Guys, welcome. I just want to give a quick message before we get into the video. This video is actually a part of my trading strategy course, which you can find in the description down below. So without further ado, let's get into this SMT divergence. Okay guys, welcome to another video, another lesson in this course. And today we'll be looking at the SMT divergence, which basically stands for smart money technique. And all it is, it's making use of a correlation between two instruments, such as the euro dollar, so euro USD, versus the DXY, the dollar currency index, because they are correlated, right? As the euro USD goes up, that means the euro is going up, hence why the dollar is going down, correct? That means the DXY overall, which measures the strength of the dollar, is going down. So to show you, and this is what we usually do anyway, right? We'll be trading EU. So this is an example we'll be using many times, and at the end of this I'll also be showing you some SMT divergence examples that I've actually taken, you know, like some trades I've taken that had an SMT divergence. So we'll have the DXY right there. So the way it works, actually, you know what, to make this better and more realistic, we'll put them like this. So let's say the euro dollar is making a higher high like that, right? So we're going to be looking at the lows. So there's a higher low, correct? One low, and this low is higher. I'll just make it more obvious. More high, it's higher there, right? So it's an uptrend, the euro dollar. So this basically shows that the euro is going up against dollar. Hence why, what would the DXY, which measures the strength of the dollar, be doing? What would it be doing? It would be going down. So literally at the same time as the euro dollar makes the higher low, as the euro dollar makes a higher low, the DXY will be making a higher high. So let me just redo that example. So as this is making a higher low, the DXY will be making, sorry, not a high high, it will be making it will be doing this. Something like this, right? So overall, the euro dollar is trending up, the DXY will be trending down. Now, what a correlated pair basically means, when everything's, you know, in perfect harmony and everything is correlated, what we will be seeing is euro dollar is making higher lows, hence an uptrend, right? The DXY will be making lower highs, right? To show that downtrend. So higher low, at the same time, the DXY would have made a lower high. That's correlated, right? Now I'll just show you another example, just so this sticks in your brains. But now in a bearish scenario, let's say we're making lower highs, right? On the euro dollar, such as that. Okay, so the euro dollar is making a lower high. So it's overall in a downtrend. The DXY hence will be in an uptrend. So the moment this makes that lower high, so signifying a downtrend, the DXY will be making a higher low. Lower high, this is making a higher low. Simple, right? That is when everything is perfectly correlated between the DXY and the euro dollar. Now, the whole point of the SMT divergence is, let's just take, for example, we personally take the euro dollar and the DXY as, you know, they're correlated. So the euro dollar is going up, the DXY is going down. Simple, right? Euro dollar is going down, DXY is going up. Simple, right? But the whole point of the SMT, and the thing that we are actually interested in trading, is when there is a crack in correlation, which means that when the euro dollar is going up, the DXY didn't actually follow it and go up, and sorry, didn't actually follow it and go down. If the euro is basically, the euro dollar is going up like that, so it's made that higher low. So what do we expect the DXY to do, right? We expect the DXY to be doing this. We expect the DXY to be making that lower high, but right at the same time as well. So the moment, exact time this makes the higher low, the DXY will be making a low high. That's what we expect. But when there is a crack in correlation, this is what happens. At the same time this made the higher low, the DXY actually makes a higher high, right? So it does this. So there's actually a crack in correlation, because what would make sense is that the euro dollar is going up, the DXY should be going down, right? And to show that it's going down, it should be making lower highs, right? But it doesn't at the same time. At the same time this makes that higher low, the DXY actually makes a higher high instead of making a lower high, right? Instead of doing this, which it should be doing because this is going up, it actually does this. Now this right here is a crack in correlation, and this is what we're interested in. And all this is just another confluence for our entries. So we're not going to be using this on high time frames. All we're going to be using this, as you'll see in the examples I'm going to show you, we're just going to be using this in our entry. So when we have an entry model about to present and we see a SMT divergence, that's just going to give us high confluence that there is a crack in correlation, and that our trade, whichever side we're playing, long or short, is higher chance of actually going out and playing through. So, you know, in your trading plan, once I give you all the tools, this will be for you to test out, you know. Maybe some of you will be like, okay, there's an SMT divergence, then I will only take the trade. If there's no SMT divergence or no Kraken correlation, then I'm not going to take the trade. Now, this will result in, you know, less trades in a month, but an overall higher strike rate, because SMT divergence just increases that strike rate and win rate. Not to say that you'll win every single time, but it is definitely a very, very high confluence that you should be using. So this is another confluence. So now, since you've understood that, I'll just show you the reverse of this, and then we will show you some actual examples I've taken of trades where this SMT divergence is present. So now let's just look at it in a different reverse scenario. So this was a uptrend on the euro dollar. Now let's look at a downtrend on the euro dollar, such as that. So the euro dollar, you know what, I'll make this easier for you. So now in a reverse scenario, the euro dollar is making lower highs, correct? As one high there, lower highs, signifying and basically confirming that downtrend. Okay, now we usually would expect the DXY to be making higher lows, right? Something like this. At the same time, this is making lower highs, but we're looking at an SMT divergence, so a crack in correlation. Hence why, as this makes that lower high, the DXY, it usually would do this, right? At the same time, something like that, right? A higher low. At the same time, this makes that lower high. DXY would be making a high low, but SMT divergence kicks in, Kraken correlation. What does it do? Something like that. It doesn't even have to be a low. It could be like an equal low, right? It could be something like that. There. So this is a Kraken correlation. Euro dollar is going down. We expect DXY to be going up, but at the same time that this lower high was created on the euro dollar, there's a lower low created on the DXY when instead it should have been a high low, right? Showing that correlation, but it's not. So Kraken correlation. This is showing a Kraken correlation, which means that if there's a break in market structure here on the euro dollar, and I don't know, a fair value gap paired with an order block, something like that, then taking a trade such as this is a higher probability because there is a Kraken correlation and SMT divergence, and overall it just gives your trade a higher chance of playing out, right? At the end of the day, this is all we can do. Position ourselves in the best possible scenario to take a trade with all the confluences working together, and this is just another tool that you can add in your arsenal. So hope you've understood this. It was a pretty short video, I think, or short lesson on the SMT divergence, but hope you've understood it correctly. And now before we go, I did promise you some examples, so I'm just going to go through that with you and we'll call it a day, and then we can get into the nitty gritty of the daily bias and all of those good things. Right now I'm on my Notion, and you will get this whole template, and this will be linked in the back testing and forward testing section of this course, the chapter or lesson, whatever it will be. But right now, so I'll tell you how to, you know, use all of that and how to journal your trades for maximum success. But this is the SMT divergence. So as you can see right there, we have the euro dollar on the 4 minute, and make sure your time frames are aligned when you're looking at SMT. And then we have the US dollar currency index on the 4 minute as well. Now I've just changed the colors so we can differentiate, but what are we seeing here? The euro dollar, there's a low there, and what's this? A lower low, okay? And we're looking to buy the market right now. So we have a lower low, and we have our entry model, all of those good things, but we have a lower low, correct? So what should the DXY be doing? Since it's opposite, a lower low shows weakness, so we ideally want to see strength on the DXY, so a higher high. But at the same time, the same timings of these lows, the same timings, if we look on the DXY, it should have made a higher high. But what does it do? A lower high, right? So there's that crack in correlation that I'm telling you about. And this just gives your trade a higher chance of playing out, and I believe this was a winner. Yeah, there's the SMT, and it just gives that higher chance of actually the trade playing out. Now, you know, there will be winners and losers, break-evens, all of those sort of things. I don't want you guys to get the impression that every time there's an SMT divergence, you know, I'm going to win. Don't add that expectation. Don't be attached to the idea that, you know, that all of this is playing out, this has to work. No, it doesn't. It's just a high chance, a high probability. Even if, you know, all of these things combining together gives you a 90% chance of winning, there is still 10% chance you won't win the trade, okay? So you need to think like that. Just sit back, relax. You can't control the markets. Literally, your trade, you can position yourself in the best possible scenario. At the end of the day, your trade depends on some big institution or big money traders, you know, buying or selling. That's what's going to move the market. That's it. So all you can do, position yourself in the best scenario, take the trade, and just sit back and relax. And the good thing is being part of a community where everyone is trading the same strategy. And even if we're not, we're all encouraging each other, which is the main thing. And I think in trading, that's so important because it can become so lonely at times. So having this sort of community feeling is amazing, and I'm so grateful that all of you can be here, and we're all just going to get better together. We're going to strive for success and improve, 1% every day. And yeah, so that is one example. Now I'm just going to show you one more example. So SMT, here's another example. So this is actually in two ways, but look at this. The euro, we're longing again, right? We've been very bullish on the euro this month. So SMT, low, low, okay? A low, low. So watch the DXY. Automatically, you guys should know. The DXY, so on the euro dollar, we're showing weakness, lower low, correct? So what should the DXY be doing? Showing strength, higher high. Let's see what the DXY does. At the same time that lower low was created on the euro dollar, the DXY created a lower high. So we're showing weakness on both. Now that's not correlated, right? Kraken correlation and a high chance of the trade playing out on the euro dollar. So that is SMT in a nutshell. Hope you guys understood. Hope this was a very valuable lesson for you guys. If you have any questions, as usual, just text me on the group, or I'm pretty sure anyone else will explain it as well. But yeah, I will see you guys in the next video. We're going to be doing daily bias and also a daily bias walkthrough, which will be very useful because, as you guys know, higher time frames hold more power. So all these patterns are all well and good, and confluences, order blocks, FVGs, all of these things are really cool. But if your higher time frame picture isn't right, if we're extremely bearish on the daily chart and you're looking for buys, then you'll probably get stopped out. It's not high probability, and we want to give ourselves the highest chance of winning, so the highest strike rate. So next module, or sorry, next chapter, very, very important, very crucial. So get your notebooks out, and I'll see you guys then.